All right, ladies and gentlemen, I want to start off talking about my journey of Iron Condors and the hedging that I've been trying to show you guys for the last 2 weeks. It has been very interesting journey. I haven't made any money, which is frustrating, but at least I've been trying to crack through the hedging process and understand how the hedging works. Um, my journey to understanding the hedging process, basically started with, credit spreads and iron condors. And I do love iron condors. Those of you, well, obviously, most of you know what the iron condor looks like. This is a typical iron condor. Okay. And the idea of iron condor, you want to box in the range of the market and hopefully it stays within that range and you make your money. You pretty much sell both sides, put spread, credit spread, and eventually, if the market closes within that range, then you make the profit. Now, why I love iron condors, like I said, I mean, if they expire both within the range, you make double the money using the same amount of margin required to open up a credit spread. And that's why I was fascinated with iron condors. But I wanted to get to the point in my life where I wanted to stop predicting direction and I really didn't want to care about the market direction. What I wanted to care about was understanding the movement of the market and how far it's going to go and how far it's going to take for that to change. So, you know, my main question that I wanted to stop asking is the market going to go up or down? And we do that a lot, especially when we sell credit spreads. How far does the market normally move is the question that I really want to ask. And that's where I started learning about statistical. And I learned most of my orb trading and statistical trading from Max Options. And I learned a lot of stuff from beautiful people from M8B group. And, I owe a lot of thanks to, you know, most of the people that I interacted with at M8B. So, including Brian, who's amazing, by the way. So what I did is after learning orb, after learning statistical trades, I came up by accident across a indicator called weekly opening range. And I took that weekly opening range by Beluga Trading, or Beluga, whoever was the name of the person who was um, programming it. It's called weekly. Here, this one right here, if you want to take a look at it. So it's for hourly time frame ideal. The first 3 hours of Monday sets up the weekly opening range for the week. Okay. Then what I did is I was created my own indicator of weekly opening range, and I started studying the data. And what I found out was, to make the long story short, was if the market breaks out through a weekly opening range, just like it would break out in a, opening range breakout on an intraday. There is a certain distance it goes before it retraces, and there's a certain distance it goes before it touches that level. And that's how I decided to create the statistical analysis. So, make a long story short, I analyzed the data for I think up to 5 years and sometimes even 20 years. And I found out that if this two orange lines represent the weekly opening range, the first 3 hours of market. If the market breaks out to a certain level, and for example, here in SPX, it has a golden area, which is the highlighted in the yellow area. If the market breaks out within that range, and then if you go another 2% away from that range, okay, or 1.5% from that range, usually it doesn't go that far because it already average weekly opening range is about 0.63%. Another traveled, like let's say a 1% travel, that's almost 2% distance travel. Okay. And if I go back to give me 1 second. If I go back to, if I go back to my statistical analysis, what I found out is on an average weekly move, meaning that from the day that you open up a trade, okay, and forward, market travels on month. Let me take it back. Average move, weekly move is 2.5% on SPX, meaning that from Monday all the way till the end of the week, it's about 2.5%. If the market this week, for example, already traveled from the opening range 1.19%. It has about another, let's say, 1% to travel based on statistics. And if you look over here, so if the market traveled 1%, there's 84% chance. If it travels another 2% up, which is what I usually take my distance for, which is about delta 15, delta 10 to delta 15 area, okay, the market has about only 14% chance of touching it again, okay? I did another statistical analysis and I found out that if you also open up a put credit spread, so making an Iron Condor right away, like I did in today's trade, which I posted for you guys, you will notice that, you know, based on statistical analysis, there's only 10-15% chance that the PCS is going to be touched within the next 7 days. Okay, so it's ideal when it's up to take an Iron Condor. When it's down, it's a whole different statistical outcome, and then a higher probability of touching the call credit and higher probability of touching the put credit, because when market goes down, it's elevator down, as they say, and the stairs up. So with that said, okay, having the Iron Condor was ideal, but finding the hedge was the most difficult part. Okay. So what I did, I came up with, a strategy where I can manage my trade, because nobody talks about managing the trade. Everybody talks about, well, if you want to sell, you do 3 times the credit received. That should be your stop loss, or 2 times, or whatever your comfort level is. But I realized, also learned from max option guys, that you can also trench. Okay, meaning like scale up. Okay, and it's risky because there's a couple of factors involved, such as GEX data, such as price action, etc. So, ideally, what you want to do is understand how to manage it before the gamma squeeze happens on your credit spreads or credit side that you're trading. So if the market starts going out, the closer it gets to your short strike, the gamma accelerates, and the more you're going to start losing. So what you want to do is you want to have a hedge. So initially my hedge was at 50 or 60%. So if the price would come to 50%, I would open up in a straight put, straight call, whatever direction was. But my stop loss on that hedge was $300. So if it did it 3 times like this and there was no movement, even though the GEX data says that there is a possibility for it to go up all the way to 80% area or even the short strike area, but by the time it gets there, I already stopped out 3 times. So on average, my credit spreads that are 7 DTEs produce anywhere from $1,000 to $1,600. If I'm lucky, sometimes $2,000 in premium. So 3 times of 300, that's already negative $900. So if my credit was $1,000, and if the hedge works out, then great, I'll make that money back. But if it doesn't, it goes a stop loss the 4th time, I'm already upside down on that credit spread, and it becomes a non-profitable trade, and I would have to close everything. So that was frustrating. So I decided, and Tom's been great and helpful. He's been showing us levels, so I appreciate you, Tom. But wanted to let you know that I started looking at different ways of the market and saying, okay, well, there's got to be another way to hedge. So initially, I came up with was inverse butterfly. Okay, so let me show you. So you have an Iron Condor here, okay, and inverse butterfly would be something like this. So if you have a trade, that is your Iron Condor, you open up a inverse butterfly on the same day. The problem with the inverse butterfly, you have to make sure the distance is correct, and it goes about 2 or 3% of the distance. And these last 2 weeks, the market's been moving very, very, very slow. So and I've also made a mistake of thinking like, okay, well, it came here, let me maximize and close it here, Okay, because hey, look, I came over here, it's profitable, all right, and then or it came here, it's profitable, let me close it. But if it continued, then the losing side kept losing more and it was devastating. So with the hedge of inverse butterfly, it's just better just to leave it alone and not to touch it. Okay, when you're here and the market is about to close, maybe you can close for minimum you're already like 80%, 90% profit here. You can close this and leave this alone, and if the market reverses, boom, you benefit. If it doesn't, then you make your hedge. You lost your hedge. I mean, you didn't lose your hedge, but you lost the losing side and didn't make any return on that. Other than that, doing what I did today or I've done in the past is closing too early. The hedge becomes a directional trade and becomes devastating. But if the market stays right here in the middle, the loss was too steep. Okay, so it's like $832 risk or $925 risk to make $75 profit. Okay, so this hedge was not always good, and I did a statistical analysis. SPX about 1.7 days out of the week stays within below 2-point range. Okay, so you really have to do 15 wide here, so it becomes 0.3%, 0.3%. Sorry, this is and you got $170 of profit, risking $1,300. If you do 5, that's great. You risk 6,000 to make $825. Now, mind you, going back to the Iron Condor, if you're getting close to say 70%, or in this case it's 1% distance, you're $1,300 in a loss, okay, plus $800, $875 profit as a hedge. That's a pretty decent hedge. Okay, the only problem is if it stays right here and closes right in the middle, you get the maximum loss, and that's going to devastate you substantially. So this was not a good idea. Okay, so then I came up with inverse. I didn't come up, but sorry. And then I discovered that I can do what's called, give me one second, inverse Iron Condors. Okay, so let's say these are the strike prices, 75.40, 75.60. I would bring here and I would do 75.40, 75.60, all right, and then 75.80, I mean 78.20 and 78.40. Okay. Sorry. Okay. So, wow, the hedge costs $27, and your maximum profit is $2,100. I was excited. I thought I cracked the code because look, I can do this for 3 days in a row, right? And then who cares? Okay, if I lose, let's say $100 in 3 days to make 16 or $2,000 of profit, that's a win-win situation, right? Well, there was one problem with that. The problem with that was if the market moved already substantially closer to your distance, meaning like it moved here about 70, 50%, or even 70% distance to your short strike where you're about to close, and or didn't make it there and you're at the hedge zone, regardless, it moves 50%, let's just say 50% of the distance already. So you move 50%, so like it's right over here. Now you got to take a hedge tomorrow at that distance away from, basically your hedge becomes more expensive. So sorry, 78.40. So now it's $127, let's just say, for the sake of example. Okay, even though this number is not accurate, it's going to be at least $300-400. So your hedge becomes non-sustainable. So I found the perfect match for that hedge. The perfect match would be if your expiration is on a third. Usually average Iron Condor, that's 7 DTE, lasts about 3, maximum maybe 4 days before you can close it for almost full profit or 80% profit. So what you do is you make the hedge at least on the third day that you were going to close. So in this case, it would be 28, 31. So either the second or the first. So I would move it to the second, and now the hedge is $322. I'm pushing for, this was 5 contracts. So it's $1,600 to make $2,100. It's about $500-600 profit. Okay, so you take $1,600 minus $2,200, so that's about $600 profit. Okay, so okay, it's not bad. Now you don't have to. Now you know that if this goes against you, you have a chance of making money and making a profit. Now let me show you this part. If it moves against you, okay, so this expires on the 3rd, this one expires on the 2nd, all right, and if it moves against you, let's say by 50%, or even let's say by 70%, and you got to close, it's $1,500 loss right here. It's 1% here. Sorry. So it's, let's say 1% here, then you're up $2,700. That would be, let's say, on the 28th. So if it moved, let's say, to your strike by 70% where you're supposed to close, so you're going to close your losing side, and this is on, let's say, on the 28th, and then your max loss here is going to be about 2,300. Your max gain here is going to be about 2,700, which in reality, let's just say if you're lucky, you break even. Okay, so it's not a losing side, but you're making profit at least on one side, and your hedge over here ends up making you some cash. You close both sides, or you can leave it on if you want to. Maybe hopefully market's going to reverse and you're going to maximize, but again, you're playing hopeful unless you understand price action, which I'm not that savvy. So you leave it alone and you close everything together at $2,700, and you can leave this alone if you want. Maybe it gets lucky and it drops to same day over here, and then you can make another profit. Swings happen in the market. However, what I'm trying to say is, over here you break even because you were about to close anyways. Over here, you can actually close your put credit because of a move of 1%, or 50% to your short strike allows you already to pretty much get 75% profit. Okay. Why, you might ask, this way? Because managing it this way, it minimizes your loss and maximizes your capital retention, or preventing your capital from maximized loss. That was the whole idea. What I did a mistake on was I would take the hedge on the 28th, and I would be like, oh my God, this is awesome. Very, very low cost, max loss $137, max profit 9,000. Yeah, if let's say Monday moves that direction, you're blessed. You can actually take 2 hedges like this. You can, as a lotto play, okay, just in case, let's say Monday market opens up, or tomorrow market opens up at 2% profit. Jesus, you're already making crazy amount of money. Now, this is not doable because market move, and on average SPX moves about 0.5 to 0.75% from the market opening price. So if it's going to move about that much on a daily basis, then this hedge is not always going to be ideal. So you want to make sure that the hedge is closer to your expiration and closer to the day that you're going to close. So usually if you're doing a 7 DTE, having a hedge at 4 DTE, and then your credit amount is the amount that you decide of how much it's going to be left for you, so you can have number of contracts based on the amount of money you want to save in a credit. If the hedge works out, obviously you make the maximum amount. If the hedge doesn't work out, you make slow and steady income. That's the whole idea. Another thing that I discovered, another hedge I'm going to talk really quickly, and I'm going to try to keep this under 30 minutes if possible, was this, that if you want to, you could actually do what's called reverse calendar spreads, which is not here if you search for it, but it does recognize it. So it's called calendar call spread. Right. And this is how the calendar call spread works. So let's just say, okay, I have this trade. It's very small amount of movement. So I accidentally discovered that, hey, if you flip this, I mean, look at it. This is beautiful, right? About 0.5% here, 0.5% here, and it's guaranteed to make you money. The only problem with this is because this expires later than the call spread, I mean, the long spread versus the short spread, the short side, sorry, the margin requirement is about $109,000. So SPX was out of question. ES, on the other hand, did not require that much of a margin. It was actually a lot less, but I couldn't tell because I couldn't see, and my account was about 100,000. So it was hard to see if it was because of that or not. So it's hard to tell. However, the margin requirement on this is substantially higher. So what I did was I created another buy call, way out of the money, change expiration to 3. Okay, now you have this. Okay, so initially your credit is 495. Okay, and if you add this call include, then now it's 380, which is not bad considering this as a if you do, let's say 30. Okay, here we go. So so if you do, you can also take it as trade like this, right at the money, calendar spread, assuming that it comes this way, you can bring it over here. I don't know, you can do it like this. If you're assuming the market's going to go this way, but you're also hedging, this way, you're like a credit spread, but this is your hedge. You can do this and you still get a net credit and you're still able to maximize if the market goes against your credit spread. So if let's say it moves 1%, you're still making $3,000. The problem with this is the gap is 0.5%. So on a slow days when the VIX is below 15, and it's been like this for the last 2-3 weeks, I've now been trying to hedge all these. It's been amazingly difficult because you can't see the full potential of it. But if the market moves 1%, then you're making substantial money. Or if you market moves 1% this way, you make it substantial money. Intraday, though, it was really hard to measure and see and observe because I made some posts that even though the market was moving in a certain direction, the amount of profit was very minimal. So it was like 0.5%. It was like $150 or something. Especially today was like 0.3 or something at the moment. So this is in a high VIX area, makes sense because you got major swings like this. It makes sense. You could actually benefit because you got 2 calls and 1 short, which kind of helps you finance these trades, and you still get a credit, which means you have a lot of money left over. You can do it at the money to maximize it, and it's ideal. It's perfect. You can do it on Qs. You can do it on SPYs as well, which does not have. Oh, great. It does not have substantial. Okay, it's not going to work, I guess. It doesn't have substantial margin requirement. Okay. So that's pretty much it, ladies and gentlemen, about the hedge. So my final hedge was this. So if you're going to do, I came up with a hedge called Stingray. I'm going to talk about that a little bit because I think that became my emphasis and I think I found the perfect ideal with that. With the Stingray strategy, I want to call it, I also had what Tom called Roblox Batman hedge, but which was also very interesting. But I'm going to talk about the Stingray right now because the Roblox. So I call the Stingray. So you change the expiration. All right. So you could have done, let's say, debit spread here, debit spread there, and it could have looked like a this one is the Roblox Batman, as Tom called it, or whatnot. And the expiration could be changed to, let's say, the first. So if it's the same expiration date, then you can have a Roblox Batman. But if you change the expiration date to ideal, like I said, if it's a 7 DTE, then within 3 or 4 days of expiration, you want to make sure that you can close your Iron Condor. That's because it's pretty much decayed if it stayed within the range. But if you were wrong, okay, you get this. Okay, 10. Okay. So this is what I call the Stingray strategy. What it is if the market is going to continue going up, okay, and like I said, if you started off with over here, if tomorrow it expires, I don't have a hedge, and if the market moves to a certain distance, I can't hedge the same way anymore, and it's going to cost me a lot more than what I paid for the credit. Now I'm hoping for a directional stance. I'm an option seller, and I really don't. I want to be as much as delta neutral as possible. So what I'm looking for is I want to find the ideal distance. So the first or the second is the most ideal that is going to be for my trade. And if I'm wrong and it goes up 2% tomorrow, let's say tomorrow it jumps 2%, I'm going to make, 700, 800 bucks, and I'll let it expire that way. I will close I will use my trade management, and I close it at 70% and let the debit spread do its job and expire in the money as much as possible and give me the maximum return as much as possible. Of course, you need to analyze the GEX data. Of course, you need to analyze price action as much as possible. Adam Mancini, if you want to look at the levels and so forth, those are great guys to use as a gauge. So, like I said, I'm going to try to keep it under 30 minutes. This is it. I don't know if it made sense or not, but this is all my journey in terms of finding out the best hedge. I think the best hedge was the Stingray strategy. You can also statistically use the inverse Iron Condor, Iron Butterfly, especially on SPX, but I guess it's not working right now. Okay, this one's off as well. Let's see, do we have, all right, last one. All right, so the Iron inverse works the best as long as it's 15 points apart or 10 points apart, depending how much risk you want to make. You have to understand, if it stays and closes at the 0 point, at your starting point, then you're going to have max loss, which is very painful. But it's about 875 max profit, $6,000 max loss. If the market jumps in the morning, let's say to a certain distance, you can actually, let's say 6%, 7% from your close, then you're making maximum profit. Average, statistically speaking, again, 1.7 days that SPX, or about 1.5 days that SPX closes between 0.3 or below. So 1.7 days, that's pretty much 2 days out of the 5 trading days, it closes between 0 and 0.3%. So it's kind of risky. Do your math, do your analysis, study. Again, this is not a financial advice. This is only for educational purposes. I'm not a financial advisor, nor am I anything of that sort. So, for entertainment purposes only, ladies and gentlemen. Let me know your thoughts in the Discord.